Hello, everyone. I'm Joyce Klein. I'm the Director of the Field Program at the Aspen Institute, and I'd like to welcome you to our webinar on the initial findings from the Asset Building Through Credit Pilot, or as we call it, the ABC Pilot. We are so glad you could join us today for what we hope will be an interesting conversation on the lessons that are emerging from this 18-month pilot program. So as I mentioned, my name's Joyce Klein, and my fellow moderator for today's call is my colleague Luz Gomez, who's a consultant to Field and who's been a key member of our team that conducted the evaluation of the Asset Building Through Credit Pilot. So we'll be moderating you through today's event. We do want to thank the organizations that made this work possible. So first we want to say a big thank you to the Citi Foundation, which provided the financial support for the Asset Building Through Credit Pilot. The fund provided by the Citi Foundation supported a number of different activities within the pilot. It helped us to provide funding to the pilot sites that delivered the secured card, also enabled us to provide them with training and technical assistance in building their capacity to deliver the card, and also funded the evaluation of the pilot. And it's the findings from that evaluation that serve as the basis for today's webinar and for the companion publication which summarizes the findings that we'll be exploring here. And Daria Sheehan, who is a Senior Program Officer with the Foundation, is our Program Officer for the pilot, and she's joined us today. And I'd like to welcome Daria and invite her to share some thoughts with us about how this pilot fits into the Citi Foundation's broader work around financial capability and asset building. So thank you, Daria, for you and the Foundation's support.
Thank you, Joyce, and I'm so delighted to be here today and that so many community partners, funders, and industry colleagues could join us for the webinar to learn more about the lessons we've learned from the Asset Building Through Credit Pilot program. At Citi Foundation, our mission is to increase the financial inclusion and improve the financial health and stability of low and moderate income individuals. A very important focus of our grant-making strategy is to support thought leadership and efforts that encourage practitioner innovation, shape industry dialogue, and promote public policy development. We do this by investing in nonprofit organizations to test, deliver, and scale innovative models that provide consumers with access to the information, products, and guidance they need to better manage their financial lives, build, and preserve assets. Evaluating and sharing the learnings from this research about what works and about what doesn't work is equally important to us. We know that in today's economy, having a good credit is a valuable financial asset and an essential milestone for achieving and maintaining financial stability. Not only does a good credit score allow consumers to access affordable lending products necessary to start a business or pay for college or purchase a home, increasingly a credit score is defining who will hire you or who will do business with you and under what terms and conditions. A few years ago, we began to invest in innovative strategies that help consumers with thin or no credit histories build or strengthen their credit scores. High unemployment rates were leading to increases in the number of individuals that were applying to microcredit institutions for funds to start their own businesses. However, many of these individuals had thin or no credit files, making it impossible for these nonprofit lenders to approve loans for them. To address this issue, we collaborated with Aspen Institute's Field Program, an organization well known for evaluating new ideas and disseminating best practices in microenterprise, who worked with 5 microenterprise organizations to test whether an additional tool, in this case a secured credit card, teamed with financial education and coaching, could create positive credit building behaviors and be a useful tool for assisting clients to move towards their goal of starting their own business. Field partnered with Justine Peterson, a leader in microenterprise development and credit building, who also played a critical role in the implementation of this demonstration pilot. It was extremely important to us that in addition to measuring client results, Field carefully evaluate and document how organizations can effectively integrate and support this tool within their organizations and determine the opportunities to achieve greater scale and sustainability. We're now very excited to share some of these early learnings with you today. I want to thank Joyce Klein and the entire Field team the people at Justine Peterson, and the 5 pilot sites for being such committed thought partners throughout this demonstration pilot. They have eagerly shared their expertise and insights and time to bring us to this point. We are very encouraged by the findings contained in Field's report, and it is our hope that those of you listening today will strongly consider incorporating some of the lessons learned and recommendations from the ABC pilot into your own work. And with that, I'll turn it back to Joyce.
Terrific. Thank you so much, Daria, for your and the Foundation's ongoing support. We really appreciate it, and thank you for those opening thoughts, which are really helpful. One of the things that Daria just mentioned is that we had a number of really key partners in the pilot. One of those was Justine Peterson, which is an asset building organization based in St. Louis, and as Daria referenced, they were really a pioneer in developing one of the first in the country to develop a partnership with a financial institution and a practice around delivering a secured card as a credit building tool. And Justine Peterson played a very critical role with us in working with the sites that we selected to replicate this idea, helping them to build and support their capacity to deliver the card. And they also manage the online portal for processing applications for the secured card. And you'll be hearing a bit later from Sherry Flanagan-Vasquez, who's the Chief Operating Officer at Justine Peterson. We also want to thank our pilot sites. Daria mentioned we had 5. There are actually 6 organizations listed here. That's because one of them was a partnership between 2 organizations. So the sites that we work with were the Mission Economic Development Agency in San Francisco, Pacific Asian Consortium for Employment in Los Angeles, the Latino Economic Development Center in Washington, D.C., Champlain Valley Office of Economic Opportunity and Central Vermont Community Action Agency, which were 2 community action agencies in Vermont that partnered together as one site, and the Local Development Corporation of East New York. So and all of these organizations worked really hard in serving clients and collecting data throughout the course of the pilot, and were very generous in sharing their knowledge with us. So in terms of our plan for today's event, here's our agenda. First, we're going to set the context by giving you a snapshot of an understanding of our research questions and the pilot design. Then we're going to share some early client outcomes in terms of what we saw in terms of some changes to credit scores in individuals who received the secured card. We'll then focus a bunch on some of the highlights from our publication on the lessons regarding the practice of delivering a secured credit card. So really focused on sharing the information that we learned about what it took for organizations to deliver this card effectively. Then we're going to briefly discuss and introduce, in a sense, give you a little bit of a teaser for future work to come. Some work we did with 2 of the pilot sites around how to make this work sustainable by focusing on the business model for offering the secured card. And as I mentioned, we're going to hear from Sherry Flanagan-Vasquez from Justine Peterson. Justine Peterson has been engaged in replicating use of a card and this kind of product with a couple of other initiatives outside of the ABC pilot, and we wanted to be able to talk with her to provide an even broader insight into the experience of working with a product like this. So that's our agenda. One more thing before we jump in. We want to get a sense of who's joined us today and what you're bringing to this conversation. So we have a couple of polls for you. The first is we'd like to know what kind of organization you belong to and get a sense of your work or interest in offering credit building products and services. So we want to know whether you're a practitioner, a funder, whether you are with a financial institution, and then also whether you currently offer credit building services or whether you're interested in credit building. So if you could respond to those that describe who you are, that would be great. And I'm just going to give folks I see you're responding pretty quickly, but I'm just going to give you a minute or 2. It really helps us to have a sense of who's joining us and what kinds of experiences and perspectives you're bringing to the conversation. Okay, so I think we're almost there. If a few other folks haven't responded, please feel free to go ahead and do that. So what I'm seeing, and you should be able to see the results on your screen. Hopefully it's, and if you haven't responded yet, you do need to respond in order to be able to see the poll, I think. So a little over a third of folks are practitioners. We also have, which is great, about 15% are funders and about 20% are with financial institutions. Slightly more of you, about a third, are interested in credit building. Another about 30% are already offering credit building services. So we have a good set of experiences that folks are, and a diverse set of experiences that folks are bringing to this work. One other kind of question, for those of you that are offering some kind of credit building services already, just want to get a sense of what kind of activities you're offering. So, and I believe you can answer more than one, you can answer several of these. So if you're offering credit or financial education, and by that we mean something that's happening in a classroom setting, so some kind of course around credit or financial education. If you're offering credit or financial coaching, if you're offering actually offering directly a financial product, and by offering both, what we're meaning is, are you offering a product along with some kind of coaching or education, or is that not applicable to you? So again, I'll just give folks a little bit of time to respond to that question. Great. So there's a number for you for whom this isn't applicable, but one of the things we're seeing, which is really interesting, is that many of you are already offering, presuming offering a financial product along with coaching or education. And you'll see that's a core element of what the design for this pilot is today. So, and for those of you who are offering a financial product, if you could chat in the kind of financial products you're currently offering, that would be really interesting for us to see, and we may circle back to that at some point. So we have about 30% of folks that are offering a financial product along with some kind of credit or financial education or coaching. Okay. So in terms of what the ABC pilot was all about, the Asset Building Through Credit pilot was designed to assess whether a secured card teamed with targeted financial and credit coaching could help entrepreneurs to build credit and build towards their business. And again, Daria painted that picture of a lot of what we were looking at here was how could we help entrepreneurs who didn't have the credit that was needed to secure financing for their business to be able to build that credit and therefore progress in their business goals. So we were looking to see whether access to the card combined with coaching could be used to create or support positive credit building behaviors, thereby resulting in increases to actual credit scores, and then ultimately help clients to progress towards their business development goals. And so the program tested a methodology that would enable nonprofits to deliver secured cards to their clients and coach them successfully in how to use that card to build their credit. And as we mentioned, we worked directly with 6 microenterprise programs. We selected the programs in early 2011. There was a startup phase during the summer and fall of that year when we trained the sites and developed the evaluation design and started to build that. The sites began enrolling clients in 2011. They enrolled new cardholders through July of 2013, and then we continued to collect outcomes data on those clients through the end of 2013, and now we're beginning to share those results. So. In terms of Field's role, we played 2 roles in the effort. We managed the pilot, which involved recruiting and selecting the sites and providing them with grants to support their costs in delivering the product and being part of the pilot. And also, we also provided them with capacity to deliver the secured card, and that was a place where, again, Justine Peterson played a very key role. Our second role was to conduct an evaluation of the pilot. And the design of the evaluation reflects an approach that's been core to our work at Field since we were created, which we and others refer to as participatory research or evaluation. And what we mean by that is in participatory is that it's an approach to evaluation that actively involves the organizations that are involved in delivering whatever product or service is being evaluated. And the purpose of the evaluation is to help them and to help others learn about and improve their work or their practice. So we also tend to call it, what you can see here is practitioner-focused evaluation. And while it's certainly not, there are lots of many kinds of evaluation, and they all have different kinds of value. It's a type of evaluation that we believe has real value in its own, especially when an organization or sets of organizations are involved in pilots or in developing a new program or practice. And one hallmark of this type of evaluation is that it typically involves more than one evaluation technique. So in this case, we used 3 different evaluation components. We tracked data on the client's characteristics and the outcomes that they achieved so that we could understand where clients were, what they looked like when they came in to apply for a secured card, and how they progressed over time in terms of credit behaviors, credit scores, and business goals. We also conducted site visits to each of the pilot sites in which we interviewed staff about their experiences in learning about delivering a secured card. And we also interviewed and had conducted focus group with clients who had received the card. And finally, we held 2 in-person training and peer learning meetings, as well as monthly peer learning calls with the grantee sites on a variety of topics. And those calls helped to build the capacity of the sites to deliver the card, but also enabled them to reflect on and share their experiences so that we could begin to identify and capture lessons around that practice. So again, this is a kind of research that's oriented to helping practitioners to learn and to take action. And at the core, the purpose of the pilot was to help individuals to build an asset, which is their credit score, which we by building their financial capability. And so let me just describe here what we mean by financial capability. The way it's defined is it's an approach to building financial capacity that's more than focused just on helping individuals to gain or attain knowledge, but is really about helping them to put that knowledge into practice. And so one of the ways to build financial capability is to team services or activities that increase financial knowledge. That might be coaching or education, with access to a financial product that individuals can then use to practice and reinforce those key behaviors. And there's a nice quote here from the Center for Financial Services Innovation about the fact that financial capability is about what you do, not just about what you know. So. In the case of this pilot, what we did is we teamed financial education with access to a secured credit card. And a secured credit card is a credit card that's secured with a deposit in a savings account. So sometimes these cards are fully secured, meaning that the credit limit on the credit card is equal to the amount of the amount of the deposit is that's put in the savings deposit. Sometimes they're partially secured, meaning that the credit line can actually be larger than the deposit. But the customer can use the card like any credit card, but the charges on the card are secured by the funds that sit in the savings account. And often secured cards are considered what's a turn-down product rather than something that a financial product will market directly. In other words, what will happen is someone will come in and apply for an unsecured card, and when they're turned down because of lack of credit or poor credit, they'll be offered a secured card as another alternative that can allow them to progress towards an unsecured credit card. In the case of this pilot, the financial product that we used was the Banamex USA secured card, and the Banamex USA card is a fully secured credit card with a minimum $300 credit limit. So clients had to come up with $300 in order to be able to access the card. So coming back to the purpose of the pilot, which was to help the client to build credit and financial capability by blending a card with credit education and coaching, the pilot's approach was built on 3 golden rules of building credit through use of a revolving line of credit. And here we want to just give some credit to the work of the Credit Builders Alliance, as well as Justine Peterson, for the work that they've done to identify factors that go into building credit. And through their work, they identified that 65% of the FICO score is based on payment history, in other words, on paying on time, and the amounts owed. And in particular, looking at whether the balances on those lines are kept low. So from that, they developed 3 golden rules of building credit and maximizing credit scores. And you can see them here. They are always making your payments on time, keeping balances on credit lines low, ideally less than 30% of the available limit, and not using the card to consume. So in other words, using the card only to pay for items that would have been purchased anyway, say with cash, not to finance the acquisition of items that someone couldn't pay for out of their recurring cash flow and that weren't a normal expense for them in the course of a month. So the coaching process that accompanied delivery of the secured card focused on these 3 core behaviors. And the training that we did for counselors at the pilot sites at the start of the pilot, which again was done by the team at Justine Peterson, focused on these 3 behaviors. So how did we measure changes in financial behaviors above and beyond looking at the credit scores of the cardholders? What we did is we had, first of all, counselors pulled a credit report on each client as they came in to explore whether a secured card could be a good credit building tool for them. And they looked at that individual's credit profile and assessed whether they were at a point where adding a secured card could help them to build their credit profile. And at that point we collected some information on their credit score, but also on what their credit profile looked like in terms of whether they had whether and how many existing active lines of credit they had. Then counselors checked in with clients at least 3 times, and occasionally more, but at least 3 times during the course of the pilot at 3, 6, and 12 months. And at those check-ins, they again pulled the cardholder's credit report and they collected data on whether they were making their payments on time, whether the balances on the card were above or below 30% of their credit limit. And they sent that was part of the evaluation data that we've looked at. So again, in those ways we're tracking very carefully and closely whether individuals are adhering with the behaviors that we've set out for them as being the key behaviors that will help them to build their credit. And I should also note that the coach also met with or spoke with the client to collect some other data as well that fed into the evaluation, but also importantly used these mandatory check-ins as a way to reinforce these key golden messages relating to these rules and these key behaviors for building credit. So that's sort of an overview of what the pilot looked like. Again, if folks have any questions, one of the questions we had is the card reported to all 3 bureaus? Sherry, I'm going to briefly shoot that question to Sherry Flanagan Vasquez. Sherry, can you chime in and let us know what the status of that is?
Sure. The card is reported to all 3 credit bureaus.
Great, thank you. I thought so, but you're the expert here, so I wanted to make sure about that. So great, thanks. And folks should please feel free to chat in any questions. I don't see any right now. So I'm going to turn it over to Luz Gomez and let her take us through some of the preliminary findings in terms of card performance.
Great, thanks Joyce. So the profile of clients who are identified as good targets for the secured card and who ultimately applied for these cards largely fell into 2 categories. So the first, and you see these on the left, so the first for those with no scores or that were new to credit. Many of it, of course certainly not all of these folks were new immigrants and were just beginning to establish credit. A larger second group of applicants were those who were looking to rebuild their credit. And so this second group was comprised largely of clients who had no recent active lines of credit. But now, for example, those who were in the midst of a foreclosure proceeding or that had recently gone through bankruptcy were not a good match for this card. On the right, you see the card volume for year 1 of the pilot. And we ended up extending the pilot, as Joyce mentioned, for another 7 months through July of 2013 to be able to collect more data from both the pilot side as well from Justine Peterson. And so we did that to conduct a more robust analysis of the client outcomes. But you can see here that even in year 1, the approval rate remained high. And you can see here it was at 93%. And that was in large part due to the very clear and transparent underwriting guidelines provided by the financial institution partner. And we're going to come back to that later in the discussion. Okay, so, and again, we're going to be releasing a broader publication on the full client outcomes of this pilot, but we wanted to share some early findings today. And so this data analysis is even more up to date than what's available in the publication. the companion piece to this webinar. And we're just now in the process of analyzing the data, but here are some preliminary findings. And so what you see here is a breakdown by percentage of the direction of changes to credit scores at month 12. So among the 223 clients for whom we had 12 months of longitudinal data, 71% saw their scores increase, 25% saw their scores decrease, and 4% saw no changes in their score by month 12. Now those percentages include both clients who didn't have a credit score when they received the car, as well as those that started with a low score. So in many ways, it's actually better to look individually at each group to separate out those who came in without a score with those who came in with a low score. And so among those with no scores at intake, we saw an even more dramatic improvement. So 92% had a score by month 12. So those figures give you a sense of the direction of changes to credit scores, but going deeper, by how much were those scores actually improving? So here again, we show data broken out by clients with 0 scores at intake and those with a score at intake. So at 12 months, those that came in without a score at intake and had established a score by 12 months later had a mean score of 612 and a median of 666. So they did pretty well. The clients who came in with a credit score at intake had a mean increase of 13 points and a median increase of 12. So as we saw previously, there were a number of clients whose scores decreased. So this obviously brings down the average and the median changes for this group. But if we look specifically at the roughly 2/3 of clients who came in with a credit score and then experienced an increase to their score, and you can see that on the right, you see a much more substantial increase with a mean score change of 48 and a median of 40. So clearly it's more challenging to rebuild credit. The score changes are less dramatic than that of clients with no scores at intake, yet it's still significant given it's only a short 12-month period. All right, so we just saw the changes in scores, but let's look at the actual scores at 12 months for those, again, who began with a score and saw increases to their credit scores, which again was roughly 2/3 of that group. Now the mean and the median are 632 and 633 at 12 months. And the average FICO scores for that same group was 584 when they first took the secured card. So you see them moving from the 500 range, dipping into that 600 range. So pretty, again, a substantial increase in 12 months for a group that already started with a low credit score. Now, as you can see from the data, there are positive trends, but some are negative, and it shouldn't be surprising as the pilot's dealing with people who will have a very diverse experience. Underlying this data, though, what we saw was that not all clients adhered perfectly to those 3 golden rules of credit building over the course of the pilot that Joyce just covered. Challenges or emergencies arose, especially for those clients who were lower income and had fewer assets to fall back on. So there were clients who missed payments, and this could bring down their overall scores or limit the increases they experienced. Some other clients consistently maxed out their card, although they usually paid it off in full each month, and so they weren't taking a full advantage of the card's ability to build their scores. We also saw that there were clients that had access to other lines of credit, which could have either a positive or a negative impact on their scores, again, depending on how they use that credit. And so we're in the process now of doing a little bit of a more detailed analysis of the data that we collected to see if we can delve more deeply into different factors that correlate with changes in credit scores. And again, we'll be sharing those findings soon in the spring. But additionally, and we mentioned this back in the beginning, we'll be sharing findings on what we see in terms of the extent to which clients were able to progress towards their business goals. Again, this is another important element of our pilot. And so as part of our evaluation, we did also speak to clients who had received the card in our different pilot sites so that we can get a deeper and more qualitative look at their motivations and experience around credit. And we spoke with several clients who clearly were showing the beginnings of behavior change around credit card use. They're really using that language of the 3 golden rules of credit. And so check-in meetings with their counselors really served as reinforcement of those messages. And those check-ins really allowed counselors to develop troubleshooting measures with clients that were undergoing difficulties at different points in time. And so we pulled these quotes from our individual interviews and focus groups around what they learned from being involved with the pilot. All right, but let's get into some of the lessons around the practice of delivering a secured card from the perspective of different players within the delivery process. So I'm going to look at the coaches first. And so what we learned was that there needs to be a comprehensive approach to credit building at the organization. And these are some of the characteristics of a comprehensive approach in our view. The first is pretty straightforward. You need to have a mechanism and the capacity to analyze credit reports. But you also need to do it in a systemized way that helps to build credit. The next one involves offering tailored assistance. Sometimes that could mean helping to facilitate something like activating the secured card when the client receives it, or helping the client to set up a monthly payment process that works for them. So it's simple, but very, very tailored to those individual clients. This also meant focused financial coaching to address a client's specific needs and outlining simple steps for the clients that were clear, that were timely, and that were relevant to building credit. All the organizations in the pilot work towards using what's called a credit action plan. And this is basically a simple document created for each client that gives individualized steps to follow for credit building based on their specific situation. Now, monitoring the client's performance on the card on a regular basis was also critical, again, as I just mentioned, to troubleshooting early problems or issues and being able to provide guidance when it was needed. And as we noted, the pilot sites were all required to pull credit reports and check in with their clients at 3, 6, and 12 months. But what we saw was that a couple of the programs moved towards pulling reports monthly when they found that some clients were actually having difficulties and they wanted to learn of those challenges earlier on. So a structured plan or timeline to follow up and monitor those clients really keeps the process both efficient as well as manageable. And we're going to come back to this point when we talk a little bit about the relationship with the financial institutions partners. But let me highlight the last two points to this comprehensive approach. And that was to focus on credit building and not credit repair, and the use of some standardized tools. So let me make this distinction here, and you can see our graphic here on the left. Credit building focuses first on establishing new active lines of credit. And so this guideline is based on evidence that the fastest way to increase a credit score is by performing well on active lines of credit that are reported monthly to the credit bureaus. Now this approach contrasts with the credit repair focus, which focuses first on examining all the debt a person has acquired and then devising a plan to reduce or eliminate debt. But I wanted to stress 2 points here when recommending focusing on credit building versus credit repair. Now the first point is that for clients that do have outstanding debt, particularly if the debt is high price debt, it is important to ultimately address that issue, and that in most cases the coaching that participants in the pilot received looked at debt and addressed it as part of the overall coaching that they did receive. But it's important to note that that step won't produce the most rapid growth in a client's credit score, and so it's not the starting point for what we're calling credit building. Second, not every client's a good candidate for a credit building approach. Clients with large amounts of collections debt, existing active lines of credit that are past due, or those that aren't generating income and therefore don't have the capacity to repay debt aren't good fits for a credit building strategy. Now, the second lesson or the takeaway that I have here on this slide is that coaches found that having access to standardized tools helped to facilitate the coaching process. Those included FAQs and easy-to-use checklists for both clients and counselors that help prepare clients and coaches in delivering the card efficiently and to help incorporate learning in the offering of the product. Justine Peterson also stressed that establishing accountability was critical to a solid coaching relationship So using tools like credit action plans that I just mentioned, which outlined, again, specific simple steps to credit improvement, as well as introduction letters, which outlined how the check-in or the monitoring process would work. So those were critical to establishing a good, solid coaching relationship that incorporated accountability. Now, coaches also found that some clients had inaccuracies on their credit reports, and for these clients, having templates of dispute letters was often helpful. And one of our pilot sites actually held what they call dispute labs, which were specified times when clients could come in and use a computer to work on dispute letters, and there would be a counselor there to help them as they needed. Again, all these tools allowed coaches to efficiently deliver tailored assistance to clients that needed it. Now, there are also two important takeaways with respect to marketing the card, which Joyce will touch on in just a moment. But I'll highlight a couple things. So the first is that, and it gets to this point of really integration of this credit building ethos, and that's to, when it's made to work, internal referrals within the organization were often the most effective and efficient source of clients. So this required building knowledge across programs or divisions within an organization, which wasn't always easy. But again, when it worked, these types of internal referrals tended to produce really good clients at a relatively low cost. And this is also relates to the coaching, because another key finding is that the trust in the coach is one of the key factors in selling the card. So for clients that lack or have maybe negative experiences with financial institutions or credit, by having an individual who they trusted to vouch for or recommend the card was really critical in the client's decision to apply for and take the card. So those are some of our key learnings that are highlighted in our publication. So why don't, Joyce, I'll turn it over to you to delve into the takeaways for leaders.
Great. So one of the things we did in our report, and as we looked at trying to pull some of the lessons here, is we tried to look at lessons from various points of view within the organization. So Lou's just summarized, what does this mean for the coaches, the folks who are working on the front line directly with clients around helping them to apply for and manage these secured cards well. But another perspective that we wanted to look at was, what is the perspective for either the organizational leaders, the CEOs, the executive directors, or the program managers who may be overseeing a microenterprise program or a credit building program within an organization, and identify what some of the lessons were from their perspective. So one of the most important lessons that we drew was that to really make this work well, credit building needs to be central to the mission of the organization. In other words, that the ethos of credit building and the importance of credit building have to be an apparent and an important aspect that's espoused by and supported by the organization's leadership. And that's important in part because the organization really needs to provide the resources and incentives to make the program successful. And it's not really just about sort of adding on another line of business or one additional product and having it function as a silo. That the organizations that were really the most successful in delivering the card really looked and saw that delivery of this card really connected to their mission, and it connected maybe across or related to several different programs and elements within their organization. And so they looked at how to embed the card within the delivery of other services, or how to connect it to other parts of what their organizations do. Resources and infrastructure were also important and an important component of building the capacity and to deliver the card effectively. Now, obviously the purpose of any pilot is to try different things, and some of those will work well and some of them don't work so well, but hopefully we learn from the experience and figure out how to do things better. And one of the things we saw was that, as Lou's mentioned, the sites tried an array of different marketing activities. Some of these are very typical sort of nonprofit marketing strategies, such as marketing to partner organizations that might provide referrals to candidates for a secured card, or as Lou's mentioned, marketing internally within other divisions or programs within the organization. Some of the sites also use more broad-based strategies, such as doing some local PR around the fact that they could offer a secured card. They did a lot of grassroots outreach, including just sort of posting flyers and things like that in the community. Some of the lessons that we learned in terms of marketing was that, that first of all, it was important for organizations to not only to do the marketing, but to have a sense of a focus on tracking and metrics so that they could really identify sort of how many folks were coming through the door, what that pipeline looked like in terms of how many people inquired about the card, how many people were counseled, how many people moved through the application process, so that they could identify the sources of where folks who were good customers and getting through the process, where they were coming from, so that they could really invest in what are the most effective strategies for marketing the card and for getting in clients. As we mentioned, some of the larger organizations in the pilot had to really work at making purposeful links to other parts of the organization that had potential clients, and that meant involving or creating consistent ways of sharing information about the success of clients who were referred into the program, what they saw in terms of improvements in credit scores and other kinds of achievements that client was able to reach with the card. It definitely involved an ongoing process of engaging more than once with other departments. We also found that it was really important that organizations could become and get really clear about the value proposition for the secured card and the message that was used to communicate that value proposition. And I think we clearly learned that our pilot site's understanding of what that value proposition was and what the right messaging was evolved over time. And I think one of the clear lessons is that the value proposition is not in providing clients with access to a credit card or a secured credit card. And at least that's not the messaging that resonated. What resonated was a message that credit is an important asset, that having good credit brings lots of benefits, and the secured card became a tool for building credit. So really the messaging was around this question of why credit is important, and how the organization had a very clear product that involved coaching and the card that could help individuals to build their credit. So, and I would say that one of the reasons it was important to market the program and not just market the card is that many clients didn't understand enough about what a secured card was, or how it would help them, why it was a good tool to help them build credit for the card itself to be a selling point. So in the paper we give some examples of what some of the successful marketing messages were, but that issue of getting clear on the value proposition took a while, but we found it to be important. We also saw that several of the programs were challenged because they had clients who went through the counseling. It was determined that they were a good candidate to use a secured card to build credit, but they didn't have the $300 deposit readily available to put down as security for the secured card. And so what we saw some of the programs do was create linkages to other products that could help the individuals to come up with that to security deposit. So some of them created linkages to credit unions that had credit building installment loans, where they could either build towards or borrow that $300. Or some of them also, the folks who were in the pilot site Meta in San Francisco, were able to refer folks to the CESTAS, or the savings circles facilitated by the Mission Asset Fund, which enabled folks to come up with the funds that could be used again to secure the card. And that was a nice model, because what we saw was that if folks were able to borrow the money to put down the deposit, they were able to generate both an installment line and a revolving line of credit, which helped them to build their credit even more quickly. So what we also saw was that managing a program that delivers a financial product also benefits from systems that strengthen and support the sales capacity of the staff. So this is particularly important if achieving some level of scale in delivering the product is important to the nonprofit that's delivering the card and or to the financial institution that's the partner and whose card you're using. So, and we're not saying that scale necessarily has to be a goal, but as we will talk about a little bit today, and even more so when we present our final findings in the next webinar we do in this topic, there do appear to be some economies of scale in delivering the card. At least at some level, we saw that the per card costs, the delivery costs dropped as the number of cards increased. But also because financial institution partners are going to have to invest some resources in the partnership. So I think they're more willing to stick with it if they see there's at least a baseline number of cards that are being delivered and potential new customers who are being brought in through offering this partnership. So getting to at least a baseline level of scale, and by that we mean delivering at least 50 to 100 cards a year, can really be supported if programs build tracking systems that enable counselors and managers, again, to track clients' progress through the coaching, to get a sense of what that pipeline's looking like, where the right good customers are coming from, and helping them to identify, again, the characteristics of clients that are most interested in and successful in using the card. We also found that professional development is important, that building the skills, particularly around the coaching elements of the card, was important. Across our pilot sites, all of them came in with some expertise in financial education, but still across the different coaches who were involved, we saw a variety of skill levels in that area. Some of them were new on the job and were hired for this program, and therefore were somewhat new to financial and credit coaching. On the other hand, there were others who had been doing this kind of work for years. But for all of them, the three golden rules about using a secured card to build credit were fairly new. So the training that we were able to provide was really useful. And for organizations that are thinking about delivering a product like that, we'd say take stock of the skills of your staff, and that there are some resources out there, such as CBA's training on credit, or the NeighborWorks training that's available on financial coaching, that could really help to build a team that can successfully deliver and scale a product like this. And going from focusing solely on coaching or financial education to also offering and in many ways selling a financial product isn't necessarily an automatic transition for folks, so that while some organizations deployed existing staff by augmenting their skills, sales skills are really helpful to get the value of the product across to the customer. And so one of our takeaways is that the organizations really want to get to large scale with this product, it's worth thinking about how to hire for a set of skills that are really around sales, and thinking about how one might think about rewarding that. So we've had a couple of questions come in from folks around costs, so we're going to turn to that now. Because obviously that's a critical factor that managers are going to be thinking about as they think about, and organizations are going to be thinking about as they think about whether they want to offer a product like this. So we work with the sites as part of the evaluation to collect some fairly detailed cost data. And we looked at what it cost folks in the pilot in the startup phase, and then what the expenses look like during the pilot period from when we started to directly offer the card. So you can see that the startup costs varied significantly across the programs, from a low of under $1,300 to a high of $18,000. Part of that had to do with the structure of the organizations and what their staffing looked like when we started the pilot. So we had one organization I mentioned that hired a new staff person and brought them on board to manage this program. And because this was their sole responsibility when we were in their startup phase, this is where they were spending a significant part of their time, and that individual is getting trained and spending a lot of time developing systems and things like that. So some of the other organizations that had existing staff who were financial coaches and credit coaches spent a lot less time sort of getting them up to speed, and also had them doing their existing lines of work until the pilot really got off and running and we began to coach clients. So what we did see, though, is some similarity across the sites in what they spent those resources on. So the vast majority of funds were really allocated toward a mix of salary and office and overhead expenses, and salary clearly being the biggest expense among all the programs. And we saw this both in the startup phase as well as during the pilot period. It's really the staffing costs in some of the startup phase and the early parts of the project that a lot of those staffing costs went to marketing, and later on, as clients began to come in, those staffing costs were really around the coaching elements of the program. So I think we've had some questions about whether what the cost was per client, and we're going to be sharing some of that in the next webinar we do. We do know that organizations spent an average of about 9.5 hours per client in coaching and delivering the card. So. And you can see that we collected expenses during the pilot period, and again there was a range here, but you can see the range was around $35,000 to $45,000, and that included the coaching costs, but it also included sort of the management and evaluation costs as well. So understanding the costs involved in running the program provides a good segue to the keys for developing a strong relationship with the financial institution that's going to be providing the secured card. Obviously the first lesson is to understand your cost structure, and for organizations to understand that you'll need financial support for that key coaching bit, the element that's critical really to delivery of this product. We're not necessarily saying that the costs all need to be paid by the financial institution partner. If your organization has existing coaching programs and resources that can be leveraged to support that part of the work. But it's important to realize and to be able to convey to your partner that coaching is an integral part of the product that's being offered, and the financial institution partner should be aware of that. A second lesson is, that's important is it's really helpful to be clear about how the secured card is underwritten so that there can be a high conversion rate for individuals who apply for the card. So as we mentioned, the trust we saw was a really key factor in whether clients decided to take the card. And I think one of the reasons the trust is so important is that many of these individuals are coming to the card and to the program having had negative experiences with credit providers or financial institutions, in many cases because they've been turned down for credit. So if coaches understand the underwriting requirements for the secured card, they can counsel clients accordingly. The reason that we had such a high approval rate in the pilot is because for the most part only clients who met the underwriting requirements submitted applications for a card. And for those who it wasn't really the right fit, they could be provided with other kinds of assistance. So if they needed to focus on credit repair or repaying debt given the status of their credit profile, that could be assessed up front, and that could be where the credit action plan was focused. We also found that having a designated point person who could really be a liaison to the banking partner or the financial institution partner helped in troubleshooting or smoothing over any problems that clients may have faced, especially in the beginning of the program. And again, folks are just developing, in many cases, their relationships with financial institutions. Often there are some barriers, language, cultural understanding barriers, and we found that having one person in the organization that could serve as a connection to the financial institution was really useful. And finally, it's also important to really understand the range of secured cards that may exist in your local market in order to identify who a strong partner is and assess and understand the value of a specific secured card. So in looking at credit card products, many of us tend to look immediately and initially at the issues of pricing and fees, and those are obviously really important things to consider, but we also found that there were other factors that were important. As we just noted, understanding the criteria for underwriting, understanding what the criteria were for graduation to an unsecured card, because that's what the goal of many individuals will be, is to get to an unsecured card. Understanding the institution's approach to customer service and how that fits with your client needs. Other valuable features, can the financial institution help to maybe provide a savings product or a small unsecured loan that could help to the client to come up with the deposit is another feature to look at. Those are equally valuable to consider in thinking about what the who to select as who to look at as partners in this process. And so those are some of the other key takeaways for institutional leaders. The final thing we wanted to talk about a little bit, and this is sort of the flip side of what's key for organizational leaders, is what's important for financial institutions to think about as they might look at for nonprofit partners. And and for them to think about as they go into building a relationship. Again, one of the key things is it's really useful to the partner to provide clarity around underwriting. That facilitates high approval rates. It means you're spending less time looking at applications that aren't a good fit, and it just builds trust with the clients and with the financial institution. It's important for financial institutions to understand that the coaching is an expensive but also a highly valuable part of the process of bringing these individuals in as customers, and understanding the costs involved in product delivery and helping to compensate the nonprofit or assure itself that the nonprofit can cover those costs under their existing service model is really important. Also, it's important for the financial institution to really understand and develop a product that hopefully will provide good value to the customer. So some of the things to consider including, what's the language proficiency of your organization in order to be able to connect to certain kinds of customers. They may have certain language needs, thinking about what kind of payment options are available for the card and how those fit with what the potential customers might be able to bring, whether you can provide text messaging as a way to, for example, remind folks that their payments are being due can be a nice way to support customers in being able to use the card successfully. And as I mentioned, helping to facilitate the mechanism for clients to attain the deposit. And again, this could be a barrier for particularly low-income individuals that don't have that security deposit available, can be really helpful. We've seen programs that helped clients to borrow or save for the deposit, and it's, again, useful for the financial institution to think about whether that's something that they can support. Again, picking a partner also requires an understanding of the market that the financial institution wants to target, so you can understand which nonprofits in your community are really already engaging with that target population and hopefully providing them with some kind of financial education or credit building services. Finally, it's really important to set clear metrics and expectations around the scale and performance of the program from the financial institution partner's perspective. How many cards are you looking for? What kinds of graduation or what kind of relationships are you looking to build with entrepreneurs? So, and one of the things we also mentioned is that anything the financial institution can do to support the ability of the nonprofit partner to monitor how customers are doing with the secured card. For example, if there's a way to early on in the process to have the cardholder agree to have duplicate statements sent to the nonprofit, that can be a way for them to be able to monitor how things are going with the card without having to try to pull credit reports monthly to be able to get that information. So that's a summary of the lessons across these three different sets of actors who are key to delivery of this product. And I'm going to turn it back to Luz, who I know has been monitoring the chat. Luz, do you want to tee up any questions that might have come in?
I answered a ton of them via the chat, and I think we can answer a few more after Sherry talks to us, because some of them might require a little bit of her expertise.
Okay, well, terrific. Okay, so then why don't we transition into Luz, are you going to talk a little bit about the business model, and then we'll get to Sherry?
Yes.
Okay, great. Go ahead. Okay.
So one of the other key issues that we try to understand through the pilot was whether and how a partnership like this between a financial institution and a nonprofit organization could be sustainable over the long haul. And so part of the evaluation, we tracked hours spent in providing credit building education and training, and as you saw earlier, cost data over the course of the first year to help pilot organizations in thinking through its training processes, thinking through their market channels, as well as the overall revenue and cost model. So we'll just provide a couple of brief examples here. What you see here are tools that we use to explore this issue of business models and sustainability. So the couple of tools we use is the business model canvas.
Hello?
So we worked intensively with two of the pilot programs, both Meta and PACE, to identify and analyze their business model for this line of business. And so this is what the elements of a business model canvas look like. There are 9 large boxes that represent sort of the 9 core elements in a business model. Each box has a title that identifies what the box is all about, and in each box are some starting point questions to get people thinking about different aspects of their business model. So we facilitated a process and took them through this. And as we noted before, so we'll be exploring this in more depth in a coming webinar, which I hope all of you will join. But a couple of areas that were particular pain points for the organizations were first understanding the full costs of running a program like this, and second, getting a clear, concise value proposition for the target markets that we're more successfully serving, that they were more successfully serving. And so that value proposition also needed to be tweaked and clear for donors and potential investors in this type of work. So again, you'll hear more about this soon, but we just wanted to kind of give you a taste of what some of this work involved. And now we're going to hear from Joyce will take us through some questions with Sherry Flanagan-Vasquez from Justine Peterson. So go ahead,
Great.
Joyce.
Well, thank you. Can you hear me?
Yes.
Great. Okay. Terrific. We had a little bit of a sound blip there, so I just wanted to make sure. So, well, terrific. So as we noted, Justine Peterson was very much a pioneer in using a secured credit card to build credit, and they were key partners with us in this pilot. And as we noted in the announcements for this webinar and we described so far, although this pilot specifically targeted individuals who were seeking to start a business or who already own one, we do think that many of the lessons regarding how to deliver a secured card will apply to other target markets as well. And so as I mentioned, the other initiatives that Justine Peterson has been involved in work with other groups of individuals. So we thought we'd bring them in at this point to share their experiences and reflections from that perspective. So we're pleased to welcome Sherry Flanagan-Vasquez, who's the Chief Operating Officer at Justine Peterson. So thanks again, Sherry, for joining us today.
Well, thanks for having me, Joyce. You've done an excellent job here of summarizing a lot of the key learnings that we've seen as well, working with the ABC pilot as well as the Chicago Credit Building Coalition and the LIST Twin Account Financial Opportunity Centers. A few recommendations that we make for organizations are considering having a secured credit card program is to really understand the target population and how the card is going to fit in with the target population. At Justine Peterson, we see a low to moderate income African American population that is essentially unbanked. In St. Louis, we have a high percentage of unbanked African Americans. Our client population has a median credit score of about 575. Which is due to having a thin credit file. Our clients tend not to have, sorry, I'm trying to adjust my volume, a lot of active trade lines. A lot of our clients have zero credit score or a low credit score due to lack of experience with credit. Our clients also tend not to be consumers. They don't have a lot of collection debt, and they don't have a lot of other debt on their credit report. And that makes them a good fit for credit building and for credit building products such as a secured credit card. When we approached Citi about helping us with a secured credit card program, we had already looked at our market and we were not satisfied with the existing products that we had available. Working with some of the other partners that are looking to start a credit card program, my number one recommendation is to find out what's already in your market before you start something new. Because we don't want to duplicate something that's already out there or to invest a lot of time in a product that might not be as good as something that you can partner with a local credit union on. Also making sure that it's a good mission fit, and Joyce mentioned this, if your counselors truly believe in credit building as an asset versus a debt management philosophy. The other thing that we talk about is staffing. Before getting started down the credit building path, making sure that the leadership sees this as something that they're willing to invest in and staff for. It can't really be someone's pet project, as we saw in this project is in the ABC pilot, as well as some of the other groups we've worked with. If it is somebody's pet project and that person leaves or is out for a bit, there is a hiccup that gets hard to come back from. So integrating it as part of the other services. So those are a few of the key recommendations that we have.
Okay, great. So we had a couple of very strategic, specific questions that I just wanted to put by you that have come in from the group. So one of the questions is whether checking credit at 3, 6, and 12 months negatively impacts the credit score of the clients.
Mm-hmm. Yeah, and that really depends on what service provider you're using for your credit reports. And here we're going to give another plug to Credit Builder Alliance that offers a soft pull product that is available to nonprofit organizations that are pulling credit for education and tracking purposes. So I would definitely recommend talking to Credit Builders Alliance and so that you're able to pull a soft pull that does not impact the credit score.
Okay, and we had another question about whether cardholders had to have a checking account as well, and if they did, were there automatic minimum payments set up to repay the card each month?
Mm-hmm. And the participants are not required to have a checking account for this product or any secured credit card. As you're looking to bank your clients as well as help them to build credit, it's something to consider as another product or another offering. But to get a secured credit card, you don't need to have a checking account.
Yeah, so thank you for that, Sherry. And I would just note that one of the things that some of our sites actually did spend a fair amount of time was helping the client to negotiate the process of how they were going to pay on the card and finding a way that really worked for them, whether that was, in some cases it meant helping them to get online and figure out a way that they were going to pay online, or helping them negotiate that process as well. Because again, many of these folks were very new to credit. So. Sherry, one of the other things we wanted to ask you is, given your experience, you've done a lot of this coaching internally yourself, and you've worked with a lot of other organizations to build this capacity. What are the skills needed, and perhaps not only just the skills, but the other qualities of a successful coach, and what do you look for and hire for when you hire coaches?
Mm-hmm. Yeah, and I would say cultural competency is one of the main requirements for a counselor. Being able to work with the target population, understand the place where they're at now, and help them to access tools in order to become more financially successful. So the history of working with a low to moderate income population, maybe a social service background, but really a true belief in credit building. We've seen counselors that have a debt management background, or even a financial institution background where they have all the technical skills, but if they don't credit building concept, it makes it very difficult for them to walk a client through taking on a credit building product.
Great, thank you. And then in the work that you've done with, you've worked with another, I would say 15 or 20 organizations in addition to the 6 that you worked with in the ABC pilot. So what do you think the characteristics of the organizations or their clients that seem to be important in making this really work?
Sure. Some of the most, as I talked about making sure the counselor is culturally competent, it's really that counselor at many of the organizations is the thing that sets the organizations apart that are very successful. So having a counselor that really understands credit building and is a champion for credit building. And as a counselor, I love this method of coaching. Because with credit building, you really see that score start to climb immediately, and it helps you to establish a rapport with the client because the score is climbing as you're helping them to, as you said it would. So having a counselor really gets that and really can help the client through that process of establishing credit. But also support. The organizations that have been very successful have executive directors that understand the importance of financial coaching and credit building products, and they budget for it. They work with the other staff to integrate credit building into other products so that the credit building department or the financial education department isn't out there looking for clients, but really most of the referrals from other departments that know the value of credit building and want that added value for their clients as well. Technology, and that goes back to a budget for higher level support, making sure that the staff has the ability to track the processing of the card so that there's a follow through with the client when the card arrives as to what should be done with it. And then finally, the organizations that are successful tend to have an understanding of the financial institution limitations and real desire to work within an existing system. We can all go out there and advocate to have the financial institution system changed, but at the end of the day, it's there, and if we're going to help our clients now, we need to kind of work with it.
Great. So one other question I'm going to pose, and this is going to segue into one of the questions that came in through the chat. So one of the challenges I mentioned we found in the pilot was that some clients who wanted to access the card had difficulty in coming up with the $300 to secure it. And at Justine Peterson, you often bundle a secured card with a credit builder loan, and then they can use some or all of that credit builder loan to provide the deposit on the secured card, and then the cardholder has a second line of credit, an installment line that can help them build their credit even faster. So I wanted to ask you sort of two questions. One is, how important is it to have a mechanism like a credit builder loan or some other way of helping clients come up with the deposit? And then the second is, we actually had a question come in with a chat. Can you share anything about the default rate on when someone has a dual lines? Have you seen that be a problem for any of your clients when you've given them two lines of credit?
Yeah, and we have lent the deposit on about 65% of our cards. We do micro lending and some consumer lending through our CDFI. For our clients with zero score or with only one active trade line, we find that two reporting lines of credit really assists the client to build credit more quickly when they're used in tandem, an installment line and a revolving line. So we do find that to be a very good way to help a client build credit, is mixing the two. Had clients, a good portion of our clients also bring in the deposit. So it depends on if there's that need, but also the need for two lines of credit versus just the one. As far as, but one thing I wanted to touch on with that is we do, our CDFI Great Rivers Community Capital does have a consumer loan license in the state of Missouri, and as we've been helping some of the LISC financial opportunity centers and loaning the deposit, loaning their on their twin account, we've been going around and investigating the consumer loan regulations state by state. So if your organization does want to get into that business, making sure that the licensing requirements are taken care of as well, because that does get into consumer loan licensing, not just the micro lending. Question about default rate. No, we haven't really seen a correlation of having us loaning on the line versus just having a client bring in their own deposit. That's an interesting question, since the client doesn't have any of their own money in the transaction, but we haven't really seen a correlation between those two things.
Great. And we've had a couple of other questions come in about default on the card. And so I will say that we're still in the process of analyzing the client outcomes data. So as I said, we just finished final data collection in December, and so we're in the middle of still analyzing that data. There were a number of organizations, there were a number of clients who did cancel the card where the card was canceled before 12 months, but we're still analyzing what that means, because we do know that there were some who actually canceled the card because they received, as their credit scores went up, they got offers for other cards, and they chose to cancel this one and get another one. So Luz, I'm going to ask Luz to jump in here. We don't have any findings to that effect yet. We're going to have to wait until April or May, right, to give any more.
Right.
To give any more detail that. Yeah. So look for that. That will be to come. So. We also had a question from Adam. How much revenue do you think a card needs to generate in order to cover costs? They'll only generate interchange when there's a spend. There's still some degree of underwriting and possibly some customer acquisition costs. So as advocates for a valuable product like a good secured card, how can the right pricing be established? And I think that's a really good question. My sense is that I'm not sure we have a good answer as to what, sort of what's the price that maybe that a financial institution would be willing to pay somebody else to originate a secured card customer for them. I do think that financial institutions bring a number of different perspectives to that conversation, because I think they're not necessarily, just looking at what's the spend on that card and what are they making from that card. I think part of what they're interested in is looking at are they bringing in customers who may actually graduate to other financial products and show them some loyalty. So it may not just be the unsecured card, but do they graduate to a secured card? They also may be looking at what their CRA obligations are in a particular footprint, and this is a way to bring in customers who they may not have already been serving, but may be fitting that LMA profile that can be helpful to them. And then for many of them, there are also issues just about how they view their interest in getting into a new emerging market. So I think it's a really good and important question. I'm not sure I don't know, Sherry, if you would add anything else to that question.
Yeah, no, it is a very good question, but I don't have a good answer for it. It's something that might require a little bit more conversation.
Great. We also had a question about whether we would have a per participant cost for the project by organization, and that is something that we've been focused on as we've been doing work with organizations around the business model piece. So that is something that's to be shared in the future. So, okay. Just looking for other questions in the chat. We had a question about what the overall demand was for the product. So we issued. You can if you go back to the slide that we issued in the beginning, and I'm going to see if I can get back there. During the 12-month pilot period, you can see that the 159 card applications were submitted across those sites, and we got to about, and 148 of those were approved. We actually, that was as of the first application pilot period. As we said, we extended the pilot, and I think we brought in, Luz, I don't know if you have that exact number. I think another 60 or so cards.
Right, we did bring in about another 60. And not all programs were continuing to process cards during that additional period, so that's why it's sort of an estimate at this point.
Right. And so what we see going forward is for the sites that are still engaging in this and looking to continue to move forward with it, I think they're looking at hoping to generate, somewhere between 50 or 200 to 200 cards a year. And some of them, as they've moved forward with thinking about how to offer the product, for example, Meta in San Francisco is now launching, in part with funding through the Center for Financial Services Innovation, is looking to offer secured cards to clients who come in at tax time, so not just entrepreneurs, although they serve a number of entrepreneurs, but other clients as well. And they're looking at a target at doing several hundred cards through that particular initiative. So. What we found with some of the organizations that didn't continue with the pilot is that they had relatively low volume, doing somewhere between 15 and 20 or 25 cards for those organizations. I think there were a couple of different factors there. In one, I think this is one of the organizations that chose to go with a local credit union instead. I think the sites in Vermont found very much that a local credit union product had much more resonance in that sector. Vermont does not have a lot of large financial institutions and out-of-state financial institutions operating there. So they felt they could get better traction with a credit union card, and we need to check in with them to see how that's going. Another one of the sites actually just had a relatively large number of folks who were looking to become entrepreneurs because they were not employed and they didn't really have the ability to show the income to support the debt service on the secured card. And so they were not good applicants because there is an ability to pay test that the financial institution has to do as they look to underwrite the card. So. And there were questions coming in about whether there's help available in replicating this program in other areas, and I know that that's something that that Citi is looking into. Thinking about what kinds of products it's going to continue to make available in this marketplace. And again, there's as Sherry and Luz mentioned, there are other cards in other marketplaces. And what we're hoping to do through these events and the evaluation learnings is to share some of the learnings about how that work can go forward. And again, we also would urge you to think about Credit Builders Alliance and to think about NeighborWorks as organizations that have training and resources to be able to support the coaching and the credit building knowledge that's useful and important skill for coaches to be able to deliver in terms of the coaching around the delivery of the secured card. So I think we've gotten through all of our questions. Luz, do you see anything else here that we haven't gotten to?
No, I think we got through most of them.
Okay. Well, terrific. Well, thank you, anyone. Well, we're close to the end of our time today. We're a little ahead of schedule, but since we've gotten through all of your questions, I just want to again remind folks that a copy of the first publication from the evaluation, which summarizes a lot of the lessons from today and actually goes into greater depth in many of them, so, is available on our website at www.fieldus.org, and you can link to it fairly easily from one of the billboards on our homepage right now. So, and as I mentioned, we will also be following up soon with a message that shares a link to the PowerPoint from today's conversation and a recording of today's event. So you can go back and refer to those if you have some questions. And also we ask that you please feel free to share those with others in your organization or in other organizations that you might want to partner with who you think may find them valuable. We are, as Luz mentioned earlier, working on other products from the evaluation work. We'll be releasing those in April or May, and we'll have another webinar then to discuss and share those findings. But those will focus on, first of all, as we discussed, looking in detail at some of the client outcomes, what we saw particularly in terms of changes in the key financial behaviors, whether folks were paying on time, whether they were keeping their balances low, and looking in more detail about what happened in terms of changes in credit scores, and looking as to see if we can see what kinds of factors might have been predictive in that process. And also a focus that again dives into thinking about what's a sustainable business model for offering and delivering a secured card product. So we look forward to sharing those with you as well. We'd like again to thank the Citi Foundation and our partners at Justine Peterson and the pilot sites for their support and participation throughout the pilot. And as we close out, we'd like to thank all of you for your participation today. Thanks to many of you for some really great questions. We hope that you've enjoyed today's event and that it's provided useful knowledge and insights for those of you who are considering whether to offer or to support a financial capability and credit building program.